Hi, everyone. We've talked about the need for analysis of financial statements, and where we, of course, refer to how should they be read along with the other accounting standards or the Ind AS specifically. And that is something which is, of course, the expectation by the institute also when they want us to be knowing about this topic and when they test us on this topic specifically, right? So in this section particularly, we want to talk about the best practices. So it's not something which is, a rule driven thing, but it's to be understood in terms of how the financial statements, the presentation of those, and the disclosures regarding those, should be understood or applied in their spirit, right? The whole idea is that not everything can be made on a rule driven basis, and that's where you need to understand and respect the fact that if there are no clearly defined aspects, then you need to follow certain guidelines which would become the benchmark for your presentation and the preparation of the financial statements, right? And that is something that we want to discuss in this particular section briefly. All right. We would also be witnessing, by the way, some scenarios and examples where we start applying the best practices and the disclosure requirements associated with that. Okay. So when I say I'm looking at the best practices, of course, it is expected that all the organizations would apply those in the spirit, right? Importantly, we need to observe and follow the compliances, right? We cannot compromise. We talked about it earlier, that regulatory compliances or the compliances from the accounting standards or India's perspective is a must. You don't have a choice to avoid that, right? So that is something which comes without saying. Integration of notes, you need to bring along, not just in sequence, but also to look at it. What is the appropriate set of accounting policies, estimates, and judgments? You need to, of course, disclose them correctly, right? You would probably recollect here the relevance of the integrated reporting framework, right? Where we have talked about, this is what we refer to IR, where we talked about, of course, how does the integrated reporting as a framework comes in picture. So you're doing it along with and integrating that with the financial information. That's where it comes, of course, evident. So you would see all the relationship or interdependencies of different sets of disclosures and the information as made by a company, right? Of course, that would go without saying that, the information that you're presenting should be simple and specific. You're not expected to give any general information. So there's no general information which is expected to be presented. Of course, it needs to be clarified that the information that you're presenting is not having a reason for ambiguity. It should not give a confusion. It should not create a confusion in the minds of the users as well. All right. So for example, if I say I'm looking at compliance, my definition of cash and cash equivalents as under Ind AS 7 would be relevant here. Okay, so I need to be ensuring that I'm using the right terminologies as defined by the standard. I cannot have my choice of information when I'm trying to kind of build it. So where we say that we need to use the remaining maturity as a terminology instead of original maturity, just to ensure that people understand it correctly. Okay, the simple and specific part, for example, it suggests that any generic disclosures and are specifically required to be avoided, and the primary focus should be on the company or the entity specific requirements. For example, it says that a note stated land not registered in the name of the company has been given for the use of group companies. However, there are no disclosures regarding such lease elsewhere in the financial statements. Now, essentially, there's a gap here. Okay, so while I say that if you are as an entity owning a particular piece of land, but it is available to other group companies, then naturally there is a leasing arrangement. So if that is not clarified, then of course that needs to be explained in will. So that's where you would probably start looking at it, in terms of an appropriate or a clear disclosure, right? I mean, I think the focus to some extent by this particular slide is also to emphasize on the fact that you cannot, for example, compromise on the disclosures part, right? And directly or indirectly, by the way, auditors are also responsible to ensure that these things are addressed. So that's where you start looking at it. For example, a more clearer disclosure would be, let's say, to include in the notes relating to property, plant, and equipment against the land, which states, for example, land includes area measuring, so and so acres, towards which the registration process is still in progress, and it has been given to the group companies on a lease arrangement. That's where it could be a little more clearer information, from a disclosure perspective, and it's a specific information that we want to highlight around. Okay. Again, it talks about use something which is more simplified and understandable and appreciated in case there are more technical, accounting or disclosure requirements. It could be a common scenario for hedge accounting or derivatives, as we see. It could be with respect to, let's say, some specific disclosures under financial instruments under, let's say, for example, Ind AS 107, right? It could be more specific, for example, in case of complex transactions relating to financial instruments specifically. So you need to be clearer about in terms of how should you be presenting it. It should not be too complicated information for users to, to not be able to appreciate or connect with what you're trying to say. So it says, for example, the meaning of a derivative. It says the type of instrument that the company uses to manage the risks. It is something that derives its value on the basis of something else. It is usually a contract between two parties for a periodicity. There could be variables like exchange rate, etc., that of course change the value of that particular derivative. Similarly, when you say hedging, you're trying to explain what is your exposure in terms of getting the hedging done, and accordingly, how are you addressing that exposure is something which you are trying to kind of address with the help of this information, right? So the idea is to keep it simple, keep it very, very clear for the users to understand. All right. Now, again, when you look at these aspects, this is again not very different from what we have discussed already, right? The idea is to give a true and fair view, wherein you're bringing transparencies in terms of what are your assumptions, on what basis are you preparing your set of financial statements. You're giving the material information in case something which you believe is important for the users to know, for them to understand, disclose them very, very clearly. And of course, the idea is to ensure that there is a clear, effective communications by following an integrated approach. If there are dependencies in one section versus the other, you need to highlight those parts, and you can give a cross-reference of those as a part of the integrated approach, right? The example of material is given here. For example, to us, it says a company has committed to purchase several items of PPE. Individually, each purchase is immaterial. However, total amounts are, for example, material, and accordingly, some disclosures are required to be given, right? That's something which becomes a classic example of materiality. Now, this should be, again, focusing on that part, that any accounting policies, any significant accounting policies should be disclosed. Any assumptions about the future, any judgments you're making, key estimates, etc. And this is something which is a specific requirement as well under different standards. You would recollect under Ind AS 36, where you talk about the value in use concept, right? You start looking at, what are your assumptions about the future, the goodwill calculations, for example, under Ind AS 103. So the goodwill calculations would come in the picture, right? You would remember Ind AS 12, income taxes. We will talk about, of course, areas including, the deferred tax assets probable, the future deferred tax deductions, whether they are available to you or not, whether it's probable or not. You start looking at all those estimates and judgments to be given, for example, right? Similarly, you need to ensure that the financial statement should be, giving the complete information about the set of financial statements itself, right? Let's say, for example, in this says where the accounting policy states that the balance of your debtors, creditors, and loans and advances are subject to reconciliations and confirmation. Now, this is a very open-ended statement, right? People would not be able to give or get a comfort around in terms of what is that the entity is trying to say. That's what you need to kind of be careful about, right? It says that it indicates the balances may or may not be appropriately stated. And of course, it also questions the audit process itself. So you need to be a bit more clearer about it in terms of whether your financial statements are complete or not. Okay. Similarly, for the disclosures, we talk about the taxable temporary difference, etc., under a business combination. So accordingly, you would recognize the calculation of, let's say, deferred taxes basis if you intend to, let's say, sell them in the future. So these are more technicalities, but the idea is to bring a clearer information in terms of what are your, let's say, accounting policies, what are your assumptions, your key estimates about your different sets of or elements of financial statements, and of course ensuring that the financial statements are complete in themselves. Okay, now this is where we start talking about how the examination tries to assess our understanding, whether we are able to apply the requirements of the accounting standards clearly or not. Right, let's have a look at this scenario and try to do it together. It says that Moti Limited and Sagar Limited are in the business of chemicals. Moti Limited regularly purchases goods from Sagar Limited. Ms. T, an individual and a KMP in Moti Limited, owns 80% of shares in Sagar Limited. However, Ms. T has been advised by the accountant that there is no requirement for any disclosures to be made in Moti Limited's financial statement, since the transaction is carried out on normal commercial terms and it is insignificant because it represents less than 1% of Moti Limited's purchase. The question is, you're required to analyze the above arrangement and classify its financial treatment for Moti Limited. Now, this is a classic scenario. This is a typical scenario, what you may expect from the examination. And accordingly, you need to understand and suggest to the examiner whether this is a right treatment, this is a correct treatment or not. Okay. Now, when you look at this particular scenario, clearly it's an example of related party disclosures, right? We talk about Ind AS 24 on this, whether this transaction should be disclosed or not. And that's what the question is, right? So when I look at related party disclosures, the first thing that I need to understand whether there is a related party transaction, right? And that's what we need to understand, that when you look at T versus Moti Limited, right? Are the transactions taking place between the two people, or let's say T and Moti Limited? Are these related party transactions? Okay, so if I really go back there, it says that it's a key management personnel in Moti Limited. Okay, and if it's a key management personnel in Moti Limited, automatically, within the purview of the related party disclosures or related party transactions, right? This becomes an example of, or the transactions would be covered within the scope of Ind AS 24, right? Automatically, when it is in the scope of Ind AS 24, of course, a separate disclosure, right, is required to be given. All right, that's the first statement that you want to pick up. The second important part is that the other argument raised by the accountant is that these transactions are immaterial. Now, how do you deal with that part? In this context, again, what are we trying to say? That if it's a related party transaction, any transactions, whether there is a value attached to that or not, right? Effectively, even if it's a transaction with a nil consideration, with no value, even that a transaction needs to be, let's say, disclosed as a part of the financial statement. The whole idea is that the whole idea of a related party disclosure or related party transaction is simple. You need to tell the users of financial statements that what is the quantum of transactions, what is the value of the transactions that you're taking as an entity with the related parties, right? So the entire explanation given by the accountant in the given scenario is inappropriate, it's incorrect. And that's where, if we go back to the questions information, that is, if I take it like this, it says that the accountant is suggesting there is no requirement of a disclosure because the transaction is carried out on a normal commercial term and it is immaterial or insignificant. So these arguments are invalid for us, and that's what we are supposed to, of course, explain as a part of our solution. We're saying that, of course, looking at the context, it's a related party transaction or a disclosure. First thing that we want to prove is that yes, there is a related party, first of all, because a KMP or a key management personnel is covered within the ambit of that. And then, since it's a related party, it does not matter whether there is a value to this or not, or there is a normal commercial term attached to that. These are irrelevant questions for us. Okay. And accordingly, the disclosure has to be given. Okay. So let's have a look at the formal solution on this. We're given that Ind AS 24 related party disclosures identify related parties as KMPs and companies controlled by the key management personnel. Now, as per the guidance, Sagar Limited is also a related party, and similarly between T and, let's say, Motil Limited, again the transactions are there, which is happening between, let's say, related parties only. Now, of course, there is a shareholding, so so all these entities are related party to each other, and accordingly, all those transactions are required to be disclosed when these are happening, between or among the related parties. This is required irrespective of the fact that transactions are taking place on an arm's length basis, or even if, for example, these are immaterial in our scenario. All right. Let's have a look at this scenario now. It says that Bruno Limited is in the business of providing construction services. The equipment of Bruno Limited is held under the cost model. However, equipment which is owner occupied, that is revalued annually to its fair value. Okay. Changes in fair value are sometimes reported in profit or loss, but usually in other comprehensive income. Now, as we read, we assess that we are referring to, Ind AS 16, which is property, plant, and equipment, right? So there is an equipment which is owner occupied, that is revalued to fair value, and changes in fair value basis what accounting policy I'm selecting. For example, this is simply coming from that perspective. Okay. Now, it says that the amount of depreciation charge on property, plant, and equipment as a percentage of the carrying value is much higher than for the owner occupied property. Okay. And there's another equipment owned by Bruno Limited, but rented out to others, is not depreciated annually and not fair value. Okay.